Before January 20th, I think a lot of folks were optimistic that, okay, good times are back, or it's going to get much less bad for PE once Trump gets into office. I'm not sure whether that's quite played out that way because of tariffs and a whole bunch of other things, right? I think the risk is that the shape of the curve is going to steepen further, right? Rising risk premium, term premium as well. What does that mean for your private equity business, one, especially in terms of terming out your exits? Or, I mean, are you going to be, is money going to be stuck in there for longer before they can exit?
You're right. At the start of this year, I think everyone would have predicted this would be a great year for M&A activity, a great year for transaction activity, and it hasn't turned out that way. But I'd say two things. First is we are seeing signs of it coming back. The debt capital markets in particular have been quite supportive, and we have been seeing more and more activity, even on the public market side. While IPO discounts are, of course, required, and they may be steeper today than they were in the past, we're seeing signs of them coming back to life, and the M&A markets as well. In terms of businesses and in terms of being able to exit, I think it really comes down to the type of business you own. If you own a market leader that provides an essential product or service and it generates a lot of cash flow, banks have always loved, or the debt capital markets have always loved financing those types of businesses. And buyers, often strategics, are very happy to own these kinds of companies in their portfolio. Of the 9 exits we did in the last 18 months, 8 were to strategics and only 1 was to another sponsor. And we have a business today that we are looking to sell where we have 20 people actively doing work. So by no means is the market dead. It's just people are choosing the areas that they want to invest a lot more carefully.
The kinds of companies that you invest in, right? You mentioned essential a couple of times already, whether it's products or services, right? So that's industrials, infrastructure, and back-end technology. Not terribly sexy, but very, very necessary. My question to you is, I mean, not all of this is rocket science. Why are you able to find companies like that? Or the other way of asking is, why are companies like that so badly run that they need your help?
That's a great question. I think it's what we like to say is we want to go for companies that are undeservingly unloved. There are companies that are unloved, maybe with good reason, and there are companies that sometimes have some noise around them, some misconception in the market. That means others aren't as interested in them at that time. If you're looking to make a quick buck investing, that isn't the space that we focus on. It's a lot of hard work to carve a company out of a conglomerate, stand up a new management team, put in place an operational capability and a value creation plan to run the business far better. And I think that scares away many investors that are used to investing in a time when returns could be made in a much easier fashion.
What kind of exposure are you looking at in terms of AI story? Because I wonder, if you're locked in for 5 years, for example, how do you know what AI story works 5 years later when you're looking to exit? And how do you know that you're not overpaying for something that could actually go obsolete even?
Yeah, it's a great question. I'd say I definitely believe that we are in the midst of the 4th industrial revolution. And the key word in that is industrial. Yeah. You have all of this investment in technology and all of this CapEx going on all over the world. But all of that isn't really worth much if we don't see real industrial productivity gains in actual companies. I do believe the technology has gotten to a point where we are seeing those real use cases today. And so for us, how we want to think about, from a private equity perspective, AI is as another tool in our digital toolkit to enhance the operations of our business. At its most basic.
Is it energy? Is it chips when you say industrial part of AI?
Well, I'm talking about any business we own where we can use AI to increase the productivity of our people in that business.
The beneficiaries of AI.
Exactly. And that's where I think we have always bought great industrial companies and we've made them better. We've increased their margins. We've often bought businesses that had 20% margins and made them 30 or 40. With AI, we can buy those same businesses with 20% margins and make them 50 or 60. And it's another tool to use to enhance margins, but it's much faster and it's moving much quicker than I think anyone could have imagined. We're using it in everything from automation in manufacturing, facilities. We're using it as customer service agents for a lot of the service businesses we own. And we're looking at and I'd say the front line of thinking about robotics in a much more advanced way for some of our businesses where we produce a lot of products.